Most people believe that winning investors are bold, fast, and constantly doing exciting things. They chase opportunities, make big moves, and always seem to feel like they're one step ahead of everyone else. From the outside, it looks impressive. It feels like progress. But here's the uncomfortable truth. The people who actually win over the long term are usually very boring investors. And that simple fact explains why so many people work hard, earn good money, invest consistently, yet never truly feel wealthy. Exciting investing feels smart. It feels productive. It gives you the sense that you're doing the right thing. But over time, that excitement quietly works against you. It introduces more mistakes, more stress, and more decisions that slowly erode your results. In this video, I want to explain why boring investors almost always win in the end, and why doing less is often the smartest financial decision you can make. In the United States, a large part of the middle class genuinely cares about money and investing. These are not careless people. They don't ignore their finances or leave things to chance. They follow the markets, read financial news, watch videos, and listen to podcasts on their commute. They know which stocks are hot, which trends are emerging, and which opportunities are supposed to deliver fast returns. They talk about market timing, about getting in and out at the right moment, about making smart moves that informed people are expected to make. Most of them believe that if they stay informed, stay alert, and stay quick on their feet, their financial results will eventually reflect that effort. On the surface, this logic makes sense. They work hard. They have stable incomes. Many of them earn more than the average household. They're not reckless spenders. They invest instead of letting their money sit idle. And they genuinely feel like they're trying to do everything right. But then time passes, and a familiar feeling starts to set in. Despite trying harder and investing more actively, their money doesn't grow the way they expected. Every few years, they look back and realize they're still roughly in the same place. Their income may be higher than before, but their sense of financial security hasn't improved much. Feeling truly wealthy still seems far away. The most frustrating part is that they don't know what they did wrong. On paper, they followed the advice they were given. They did what society, the media, and so-called experts told them to do. And that's what makes many people start doubting themselves. But the truth is, most of these people are not lazy. And they're not unintelligent. The problem isn't their effort or ability. The problem is that they're playing a game designed to reward excitement and constant action, while real wealth is built according to a completely different set of rules. In modern society, especially in the US, there's a deeply ingrained belief about what a good investor looks like. A good investor is seen as someone who's fast, bold, and always making decisions that look smart. Someone who spots opportunities early, takes big bets, and isn't afraid to act while others hesitate. This image is repeated so often that it becomes the standard. If an investment strategy isn't exciting enough, complex enough, or different enough, it's often dismissed as unsophisticated. This belief didn't appear by accident. It's reinforced every day by media, social networks, and carefully selected success stories. Headlines focus on people who made big wins in a short time. Viral videos highlight bold decisions that paid off dramatically. On social media, people share their gains, their victories, and how clever they were, but almost never their losses, their mistakes, or the decisions that set them back years. The problem is that we're only seeing a tiny part of the picture. The success stories we hear are usually rare cases of people who survived and won. Behind them are millions of others who tried the same things, acted with the same confidence and excitement, and quietly failed. Those stories don't get told. There are no videos about portfolios that slowly shrank. No articles about smart investors who had to start over. When we're constantly exposed to winners, we begin to confuse luck with skill, and short-term results with long-term success. We start believing that if a decision looks smart right now, it must also work over time. But markets don't work that way. Many things that look brilliant in the short term fail quietly when viewed over decades. What feels wise today is often exactly what undermines your results over the long run, just slowly, quietly, and without drawing attention. After stripping all of this away, the truth about building wealth is far simpler than we're usually told. Wealth doesn't come from how intelligent you are. It doesn't come from rare moments of brilliance or from predicting the market correctly. Wealth is not created by brilliance. It's created by repeatable behavior, practiced consistently over long periods of time. A boring investor isn't uninformed or passive. They simply don't try to optimize everything every day. They don't react to every headline, every market swing, or every emotional impulse. They don't need to win quickly. They don't need to be right now. And they don't need to prove they're smarter than anyone else. Instead, they focus on maintaining financial habits that can be repeated year after year, even decade after decade. What makes this approach powerful is precisely how boring it is. It doesn't rely on emotion. It doesn't depend on timing. And it doesn't require constant decision-making. It reduces mistakes, lowers pressure, and allows time to do the hardest work for you. While others chase the next smart move, boring investors quietly repeat the basics and let compounding do its job. That's the core philosophy here. Wealth is built through boring, quiet, repeatable behavior. It's not the most exciting approach, but it's the most effective one over the long run. The first reason boring investors consistently win is simple, yet often overlooked. They make fewer mistakes. In investing, the winner isn't the smartest person. It's the one who avoids the most unnecessary errors. Every trade is an opportunity to be wrong. Every extra decision introduces new risk. Active investors often don't realize they're putting themselves in a position where they have to be right too many times. Boring investors do the opposite. They trade less. They don't feel compelled to act just because the market is moving. When volatility hits, they don't panic. When others make fast money, they don't fall into FOMO. No panic, no FOMO, no rushed reactions, and that alone prevents many long-term mistakes. While others focus on doing things right, boring investors focus on not doing things wrong. The second reason goes deeper and matters even more. Boring investing protects you from yourself. In investing, the most dangerous variable isn't the market or the economy, it's human emotion. Fear, greed, overconfidence, and the desire to prove yourself tend to appear at exactly the wrong moments. When markets rise, people believe they understand what's happening. When markets fall, fear pushes them to exit at any cost. Boring investors understand this, so they don't try to master their emotions. Instead, they build simple, repeatable systems that don't require emotions to be correct. Once decisions are set in advance, emotions have far less influence. That boredom creates a buffer between feelings and actions, and that buffer protects long-term results. The third reason is often mentioned but rarely understood. Boring investing allows compounding to work fully. Compounding doesn't need exceptional intelligence. It needs time and continuity. Every time you abandon a plan or change strategies because you think you can do better, you interrupt compounding. Talent can't replace time, and excitement can't replace consistency. Boring investors don't try to accelerate results. They don't force outcomes in the short term. They focus on staying in the process long enough for time to do its work. Over the long run, time beats intelligence, and consistency beats rare moments of brilliance. The fourth reason is the one few people prepare for. Boring investors survive bad decades. History shows that not every period is favorable. There are long stretches, sometimes entire decades, where returns are disappointing or volatile. Strategies that require constant accuracy usually don't survive these periods. Boring investing doesn't need perfect predictions. It doesn't need you to know what comes next. It only needs you to last. In investing, survival matters more than forecasting. Those who try to look smart are often removed from the game sooner than they expect. The boring ones stay, endure the bad periods, and keep going when conditions normalize. When you step back and look at these four reasons, a clear pattern emerges. Boring investors don't win because they do something extraordinary. They win because they avoid what destroys results. They don't need to be right often. They just need to avoid big mistakes. In investing, victory doesn't belong to the smartest person in the room. It belongs to the one still standing at the end. That's why, over long time horizons, survival beats brilliance. Now imagine two people who start investing around the same time. They're about the same age, earn similar incomes, and both belong to the middle class. Let's call them Person A and Person B. Person A is smart. He genuinely cares about money, reads constantly, and stays up to date. He knows what the market is talking about, which trends are rising, and which strategies are being praised. His portfolio changes often. When a new opportunity appears, he adjusts. When an old strategy feels outdated, he switches. Every decision has a logical explanation. On paper, everything looks impressive. Person A feels like he's doing the right thing and believes good results are just a matter of time. Person B is very different. What he does is steady and, frankly, boring. He doesn't talk much about money. He doesn't show off his portfolio or debate markets. He rarely changes strategy, not because he doesn't know better, but because he doesn't feel the need to. He repeats the same behaviors year after year. There's nothing exciting to turn into a story. From the outside, Person B doesn't look special at all. Years pass. Person A goes through emotional cycles. Sometimes he's excited after a good decision. Sometimes he's frustrated when markets move against him. He spends a lot of energy thinking, adjusting, and trying to improve results. Over time, fatigue sets in, not from lack of effort, but from always feeling like he needs to keep up. Person B barely changes. He keeps doing the same things at the same pace. During bad markets, his results aren't impressive. During good markets, he doesn't get overly excited. Investing isn't something he watches every day. It's simply a foundation in his life. 20 years later, the difference is obvious. Person A looks back feeling exhausted. His results aren't terrible, but they're not exceptional either. He spent enormous energy, made countless decisions, and put in constant effort for fairly average outcomes. Person B has no dramatic story to tell, but his net worth is significantly higher. Quiet, unremarkable, no explanations needed. While Person A was busy trying to be smarter, Person B let time and consistency do the work. And that's why, over the long run, the boring investor wins. Looking at this entire journey, one thing becomes clear. Wealth is not a reward for being smarter than others. It's not given to those who move faster or discover new strategies first. Many smart, fast, and knowledgeable people end up with average results, not because they lack ability, but because they focus on the wrong things. Wealth isn't built through rare moments of excellence. It's built by making fewer mistakes, fewer rushed decisions, fewer emotional reactions, fewer times breaking your own plan. When you remove major errors, good outcomes have room to appear. You don't need to win big. You just need to avoid losing big. The real difference is durability. Boring investors don't try to impress. They don't need to prove they're right. They don't need exciting stories about clever decisions. What they value is staying in the game, year after year. Through good times and bad. That durability creates a gap that short-term brilliance can't close. When you stop trying to be smarter than the market and start focusing on making fewer mistakes, everything changes. Investing stops being a competition of intelligence or speed. It becomes a quiet, steady process and an incredibly effective one. That's why, while many people look impressive along the way, the real winners often go unnoticed. Boring investors don't look impressive, they just win. If what you've just heard feels different from the investing advice you're used to, that's not by accident. We're conditioned to believe money must involve excitement, constant action, and the feeling of being clever. But when you look at the long-term journey, that mindset often leads to more stress than results. Quiet wealth doesn't try to impress. It isn't loud or flashy. And it doesn't need immediate validation. It's built quietly, through simple, repeatable decisions that most people overlook because they seem too boring. Yet that boredom is exactly what allows it to survive and grow over time. If this approach makes sense to you, the next video will take this idea further and explain why quiet wealth almost always beats loud, flashy money. When you're ready, continue to the next video, where we'll explore why quiet wealth always outlasts loud money.